All right, let's dive right in. Today, we're going to tackle a huge question for any investor. How do you actually build a portfolio that's strong, that's diversified across the whole world, just using ETFs? Let's get into it. So, let me just ask you this straight up. Take a hard look at your investments right now. Are they really, truly built to handle the crazy ups and downs of the market, but also positioned to actually capture growth? It's a tough balancing act, for sure, and that's exactly what we're going to break down today. First up, let's talk about the big challenge, the core problem that every single one of us is dealing with as an investor right now. I mean, you've got interest rates all over the place, geopolitical stuff happening. The market is just, well, unpredictable. So the real puzzle is, how do you protect the money you have while making sure you're not sitting on the sidelines and missing out on the major growth stories happening across the globe? It's the ultimate investment dilemma, right? You know, what's interesting is that the solution to this very modern problem actually comes from a super old piece of wisdom. Let's just call it the one basket problem. I know, you've heard it a million times. But when it comes to investing, it is the absolute golden rule. This one simple idea is the bedrock of any smart, tough investment strategy. We just have a fancier name for it now: diversification.
But diversification is more than just buying a bunch of random stocks. It is a deliberate strategy. You're intentionally spreading your money out across different sectors like tech and healthcare, different kinds of assets like stocks and bonds, and different countries. And why do we do this? So that if one part of your portfolio takes a nosedive, the others are there to hopefully soften the landing.
Now, while pretty much everyone benefits from this, it is absolutely essential for two kinds of investors. First, anyone who's gone all in on one industry. Maybe you just love tech stocks, or you're all about those bank dividends. And second, and this one is so common, investors with what we call a home country bias, where almost all your money is tied up in your local market. So let's make this real. We're going to zoom in on the Singapore market as a perfect example of what this concentration risk actually looks like in the wild. So you have the Straits Times Index, the STI. It's the go-to for Singaporean investors, right? It's packed with solid, blue-chip companies that pay good dividends. But there's something hiding just under the surface, a risk that a lot of people just don't see. And here it is, 53%. That is a huge number. So what is it? That's the percentage of the entire STI that is stuck in just one single sector. And here's what that 53% is. Take a look. More than half of the whole index is financials. We're talking mostly banks. Now, don't get me wrong, these are great, solid companies, fantastic for dividends. But it means if you're only in the STI, you're getting almost no exposure to other massive parts of the global economy. Okay, now compare that to this. This is the S&P 500, the big US benchmark. Just look at that mix. You've got information technology as the biggest piece, but then you have big chunks of healthcare, financials, consumer stuff. This is what a diversified sector spread looks like. You're tapping into all these different engines of growth at once. So the takeaway here is really, really clear. The STI is fantastic for that steady, high dividend income, and it tends to be less volatile. The S&P 500, on the other hand, offers more potential for your capital to grow, and it gives you that crucial exposure to global tech. Neither one is better. The real magic happens when you bring them together. Okay, so we know the problem. What's the fix? Let's actually build out a sample portfolio that tackles this whole thing head-on and creates that global balance we're talking about. All right, here is a simple, actionable blueprint. Now, this is not investment advice, of course, but it's a great model for how to think. You could have 50% as your Singapore core for stability, using ETFs like ES3 for stocks, maybe MBH for bonds. Then 40% goes to US diversification with an S&P 500 ETF like CSPX. And you save that last 10% for some thematic growth, like the SOXX semiconductor ETF to capture big trends like AI. So why is a structure like this so powerful? Well, think of it this way. Your Singapore core, that's your stable anchor, just churning out reliable income. Your US slice is the powerful engine driving growth from the biggest economy in the world. And that little 10% thematic slice, that's your turbo boost, right? Capturing those high-octane trends that are shaping our future. It's a three-part strategy for a really balanced portfolio. So let's wrap this all up by talking about how you can take these ideas and actually use them for your own strategy to really future-proof your portfolio. The very first thing you gotta do is a quick self-check. Step 1, analyze. Be honest. Are you way too concentrated somewhere? Is there one market or sector that's a giant piece of your pie? Step 2, assess. Does your portfolio actually reflect where global growth is happening, like in tech, or are you kind of missing the boat? And finally, the most important one, align. Does this whole thing actually match your personal goals and how much risk you're comfortable with? Answering these questions is your first step.
And just to help you kickstart your own research, here's a quick recap of the example ETFs we talked about. We had ES3 and MBH for that Singaporean core, CSPX for that broad S&P 500 exposure, and SOXX for that thematic growth in semiconductors. Think of each one as a different kind of building block you can use.
And I'll leave you with this last thought. Diversification isn't a one-and-done fix. It's a process. It's about always looking ahead. So the real question isn't just about fixing the portfolio you have today. It's about constantly asking yourself, what's the next big thing, and am I positioned to be part of it? Thanks for tuning in.